So let's talk about something you've probably seen all over the place. Trading apps that promise zero fee or commission-free trading. Sounds great, right? But it begs a pretty big question. How does a company give away its main service for free and still manage to make billions of dollars? Well, today we are pulling back the curtain on the hidden engine that powers modern retail investing. This isn't just some clever catchphrase. It's really the fundamental truth of this new era of investing. It points to a brilliant but pretty misunderstood mechanism that has completely changed the game. It basically means your trading activity itself, every buy, every sell, has become a super valuable commodity. And yeah, someone is definitely buying it. And that, right there, is the central mystery we are going to solve in this explainer. The answer lies in a controversial practice that has become the absolute lifeblood of the commission-free model, and it's something that regulators and investors are fiercely debating as we speak. To solve this puzzle, we first have to understand how we even got here. The world of free trading didn't just pop up out of nowhere. It was actually built piece by piece over decades of regulatory changes and incredible leaps in technology. What's really fascinating is how each of these big market shifts kind of set the stage for the next one. It all kicked off in 1975 when fixed commissions were abolished, which, for the first time ever, forced brokers to actually compete on price. Then, fast forward to 2001, we got decimalization. Stocks started trading in pennies instead of clunky fractions, and that dramatically squeezed profit margins for brokers. And finally, Regulation NMS in 2005 created the super complex, high-speed market we have today. Each step made the old way of doing business tougher, creating a perfect vacuum for a brand new idea. And that new idea, the secret ingredient that makes all of this free trading possible, is a little three-word phrase that, honestly, most retail investors have probably never even heard of: payment for order flow, or as everyone in the industry calls it, PFOF. Okay, let's break that down because it sounds kind of technical. When you hit the buy button in your app, your broker doesn't always send that order straight to a public stock exchange like the New York Stock Exchange. Instead, they often sell your order, along with millions of others, to a massive financial firm called a market maker, who pays them for the right to handle your trade. So just to make this crystal clear, you can think of this as a transaction with three main characters. First, there's you, the retail investor. Then there's your retail broker, think Robinhood or E-Trade. And finally, there's the wholesale market maker, a giant firm like Citadel Securities or Virtual Financial, who is the one buying all those orders. So how does this actually work when you place a trade? Let's follow the life of a single free trade from the moment you tap your screen to the final execution, just to see exactly where and how the money is made. But first, who are these market makers? Well, you can think of them as the wholesalers of the stock market. Their whole job is to always be ready to buy and sell a particular stock. And they make their money on something called the bid-ask spread, that tiny, tiny difference between the highest price a buyer will pay and the lowest price a seller will accept. We might be talking about just a penny, but when you multiply that by billions of shares a day, you can see how it adds up fast. Okay, here's where it all comes together. Step 1, you place an order to buy 100 shares of a stock. Step 2, instead of sending it to a public exchange, your broker sells your order to a market maker, who pays them a fraction of a cent for every share. Step 3, the market maker internalizes the trade, which means they fill your order from their own massive inventory of stocks. And Step 4, in that split second, the market maker captures that bid-ask spread. That's their profit, and it's that profit that ultimately pays your broker, which lets them offer you that free trade. Now, as you can probably imagine, this whole system has some really fierce supporters and some equally harsh critics. So, is it a brilliant innovation that has opened up the financial markets for everyone? Or is it a massive conflict of interest that creates a hidden cost for the very people it claims to be helping? Let's just look at the arguments. On the pro side, the biggest benefit is obvious: zero commissions. It's opened up the market to millions of new investors. Supporters also say it adds a ton of liquidity to the market and can even lead to price improvement, where you might get a slightly better price than what's publicly listed. But on the con side, you've got that giant conflict of interest. Critics are asking, is your broker sending your order to the place that gets the best price for you, or to the place that pays them the most? This could lead to hidden costs through that spread and makes the overall market a lot less transparent. And just to give you an idea of the scale we're talking about, look at this number. In just the first 3 months of 2021, Robinhood made $331 million from payment for order flow. This wasn't just a side hustle for them, it was their main source of revenue. That really shows you just how deep this practice runs in the free trading business model. For a lot of us, this pretty obscure market plumbing was suddenly thrown into the spotlight during the whole meme stock frenzy. Remember that? When brokers started restricting trades on stocks like GameStop, people began asking some really tough questions about the close financial ties between their brokers and the giant market makers paying them, who, in some cases, were losing a fortune on the other side of those exact trades. It sparked this huge public debate and even congressional hearings. All that controversy has really put the future of payment for order flow, and by extension, free trading itself, at a major crossroads. Regulators here in the US are now taking a really hard look at this entire system, and they're considering some pretty significant changes. So, what could happen next? Well, there are a few big options on the table. Regulators could do what the UK and Canada have already done and just ban it outright, or they might create mandated auctions, where market makers would have to compete against each other to fill every single retail order, which could drive better prices. We could also just see much stricter disclosure rules and a real strengthening of the best execution role that brokers are supposed to follow for their clients. The debate is very much alive. So what's the big takeaway here? We've seen how payment for order flow completely democratized access to the market by getting rid of commissions. But we've also seen how it introduced this really complex system with some serious potential conflicts of interest. And that brings us right back to our central question. Now that you know how the engine works, you get to decide for yourself, is free trading actually worth its hidden price?